All right, good morning and welcome.
Good morning.
We're a nice small group. We can be pretty interactive. I'm Dean Miller, the president and CEO of PACT. People always say, what does that stand for? You will not be able to find that on our website. It stands for the Philadelphia Alliance for Capital and Technologies. And there are a lot of industries where that really matters, right? Where you have that connectivity, and financial services, as we all know, is one of those. We're sitting in one of Vanguard's hubs for technology, and people sometimes in this area aren't surprised about this, but outside the area are. There's more people in tech within Vanguard than there are managing your money, which if you stop and think about it, with trillions of dollars, you say, really? But that is the absolute truth. And when you look at the growth within the sector, the technology side of financial services is massive. We're really excited as an organization to really focus on FinTech. Philadelphia, it's a big strength. Again, some people say, really? Philadelphia's strength? Yes, indeed. There are far more FinTech companies, and we know about the Vanguards and the SEIs, which are incredible companies, but there are also a host of really growth stage private equity backed firms as well as startups in this space. Really, I think a lot of it is spawned by some of those larger institutions. Throughout the year, we do, as you know, FinTech programming. We have an advisory board like we do for a lot of our industry events. And as members, if you are a member, you get access to that, again, to bring like minds together. This is really a culmination after several years to say, you know what, there are a lot of things to talk about within FinTech. We need a little bit more than just an hour. And so, as you see, we're getting back in person. We're excited to do so. Really excited for today's program, which I think is going to touch upon a couple areas that maybe sometimes get a little overlooked. So with that, I want to first of all thank our supporters. We have some incredible supporters, obviously, in this region. I mentioned two of them that are part of this event here, Vanguard and SEI. You're going to hear from people from both of those firms. But I also want to thank Ballard and Baker Tilly. And Baker is one that's come to our table a couple of years ago. It's gotten really involved. And I'll leave this as a pitch. We're on at the end of our fiscal year. Today is June 30th. So we are focused on driving membership right now through that date. But Baker said, you know what, we don't want to just be a member. We want to be really more engaged. And for us, the model is all about engagement and really helping people to connect. So with that, I want to thank Baker and Ballard, SEI, and Vanguard, and introduce you to our moderator for our first session. By the way, we've got two sessions. They're going to be, we're not going to take a big break between them. We'll take a little bit of a pause. But I want to introduce you to our moderator, Phil Schmoyer from Baker Tilly. And Phil's going to introduce you to the rest of our panel.
Thank you, Dean. Thank you, everyone, for being here. Sorry this is loud. Great to be back in person. This has been quite a journey for the past few years. Looking forward to the conversation today. I think we have probably three or four key topics we want to touch on. We want to talk a little bit about the current state of the union in terms of FinTech. What are we seeing? What's trending? What's happening? What's happening with it as it relates to kind of data, AI, machine learning, kind of automation, what's happening with driving some of those things. I want to talk a little bit about how we build trust in a world and an environment that's fully remote and very volatile and turmoil at times. So we're going to talk through a lot of those things. And we've got a great panel here. I'll just kind of run down the list and let them introduce each other. So Russ, I'll let you start.
Sure, thank you. Russ Kleiman with SEI. I head up our corporate venture capital group about 5 miles away. Been working at SEI for about 20 years in a variety of different capacities, and delighted to be here.
I'm Matthew Bellows. I'm the former CEO of a FinTech company called Bodeswell, and as of the beginning of the month, we sold a business to American Express, so I'm a new biz dev guy at American Express.
Good morning, Terrence Kim. I am part of the investment management FinTech strategy group also at Vanguard, and I'm actually relatively new. I joined Vanguard about 3 months ago.
So you couldn't get into this building either?
Then it's a testament that everyone did make it in the building. Got some smart people there. So we want to kick off just kind of getting a lay of the land in terms of the state of the union and kind of what's happening. I know when we had our initial call, I know Matt had a great kind of conversation point around, we can't start a conversation around FinTech without at least addressing kind of what the market is doing and how we're approaching it. So Matt, you want to give us a kind of a quick overview in terms of what you see, what kind of drove you to kind of some of the decisions you made as a startup founder, and then how you're seeing the market play out.
I don't think it's news to anyone that everything's changed with the stock market in the last 6 months, and so the way that impacts startups is that everything's magnified, right? With a startup, who here has done startups versus small businesses? Yeah, so you know that you're much closer to the metal, and there's much less room for error. And I didn't predict that this was going to happen and therefore sell to Amex. It's more like Amex and Boswell had a great partnership and built something together. It made sense for them to buy us, but it was a convenient time to leave the startup world because right now it's very, very, very hard for startups to raise money because either they've raised at outlandish valuations before and now they can't make that valuation again, or the venture capitalists are just not interested in taking the meeting at all. So we're at the beginning of a new phase of FinTech development, which has a lot to do with less about spending money to get customers and more about building stuff really well so that customers come to you.
Yep. Good sense.
Yeah, the other key interesting trend that you'll notice is that there are non-traditional VCs kind of jumping into the investment world. Tiger Global, I'm sure you guys have heard for different reasons, but they're not a traditional VC player who's into that investment market. They have jumped in quite heavily. You see guys like CBC, the coin-based venture arm, investing heavily. Now they're obviously pulling back, but it's a very unique market now, right? You see these non-traditional players jumping in. There's always this sort of oversupply of money chasing very few deals in the beginning, but with this extreme movement from one end to the other end, a lot of money are actually being pulled back. But I think at some point we'll just find the equilibrium, just like what you see on the market. Or hopefully it does.
Yeah, I mean, I would echo what both gentlemen said. I mean, I think one of the things that we're seeing, I happened to be at a global corporate venturing conference last week, and a lot of the topics of discussion was, what's happening within the market, what has the public markets then done with the recalibration, and how that's trickled down into the private markets, both at the private equity, growth equity, and now, certainly later stage and early stage investing, and how that's kind of trickling back. I think one of the interesting things that I think there was a general consensus is, while the investors have seen a recalibration of valuations and raises, we don't think the founders have rationalized that yet, or at least admitted to it or are comfortable with admitting to it yet. So while, later those that have raised rounds, in Q4 and even early Q1 of this year, I think are still anchoring on to that, anchoring belief that this next round will be just as good as versus, maybe a down round. And so I think that's one of the bigger challenges in the marketplace right now is that, I was sharing with somebody earlier that, we were talking to a firm that's in the financial planning space, and they're like, we've got 4 term sheets, we're shopping, we're working on term sheets, we're waiting for the right valuation, and we're gonna get anyone, we're gonna sign it this Friday. That was 4 Fridays ago, and I haven't heard from them. So I think the reality is starting to set in at the founder level that there's a recalibration that's happening, and I think that in and of itself is forcing, I think, to the comment around kind of like a more microscopic look at, it's not just 18 months of runway, it's more what's your path to profitability, it's more around how do you weather, a 24-month, maybe even longer downturn. What are you going to do now to position yourself for that in the future? And I think what we're seeing is the smart founders are already beginning to recalibrate, with resources, with spend rates and burn and things of that nature today before they have to react to it. I think the founders who are still in that optimism or delusion, depending upon where you put them, are going to wait. And if they wait, it's going to be too late.
Yeah, it's a very interesting point, and I think as founders start to recalibrate, some startups start to recalibrate, some largers look differently at how they're investing, what that strategy is. How does that drive kind of the services they're providing and the ability to continue to deliver top quality support, meeting the consumer expectations and behavior? What do we see as kind of some of those driving forces as we move forward? If anyone has any thoughts?
Do you mean how do the fintechs continue to serve when they don't have the money to invest, is that what you're saying?
Quite possibly, yeah. So on that side, and then also how, or if potentially, do the incumbents see this as an opportunity to start to innovate more because they have more of the money and try to capitalize on that vulnerability of the lower market?
I would certainly hope so. I think that is a great opportunity because suddenly all these SaaS companies that build great software and hold a lot of consumers into a different kind of banking or investing experience are now 80% off. You know, and so that seems like a very good opportunity for a large company with huge balance sheet to go out and pick up some innovative talent.
I think it's a combination of activities. I think certainly, again, I think those smart founders and leadership teams within the startups are trying to recalibrate how do they continue to maintain those service objectives, hit their roadmaps, continue to develop and build out, and be smart about their capital deployment. But I think to the comment around, you know, this notion of, you know, from an M&A standpoint, and even strategic partnerships, joint ventures, things of that nature, where you can say, hey, look, you know, we thought you were a good fit, we still think you're a good fit, but we actually think, you know, potentially an acquisition or strategic partnership is a better fit. And so I think that, you know, the vulnerability element, I think raises, you know, continues to raise, and I think this is where, you know, are the founders well capitalized, or the teams well capitalized, and are they forward thinking, or are they going to kind of wait to the point where now, you know, they're in this, you know, oh shit moment, where they've got a book of clients, they need to react, and now they're knocking on the door of the last strategic investor, or, you know, reaching out to a, you know, investment bank and saying we need to explore options. So I think you're seeing kind of a multidimensional approach to kind of continuing that operations.
Yeah, I mean, look, fintech strategy companies exist because there's a need, right? It's a whole different skill set to actually identify the need, and whole different skill set to actually grow that into a proper company. And whether they, you know, whether it's this specific event that's occurring right now, eventually it'll get normalized, right? So the good companies will survive, and there'll be those that will not.
Yeah, and the fact of the matter is, like, building software is still hard. It's just as hard as it is now as it was 6 months ago to build something that consumers really want to use or businesses want to partner with. So that hasn't changed. The financing environment has changed a little bit about how to finance that. But the problem is still there, and therefore the opportunity for companies with balance sheets is even greater.
Yeah, we hear a lot in the market lately about these financial super apps, and obviously with some of this more partnership potential, those super apps could be even more super. You can start to extend and bundle and add more. As we're thinking through it, I guess, what was the driving force behind some of those super apps, and you know, do we see that trend continuing? Do we see kind of extension into other areas, into other markets? I don't know if anyone has any thoughts on that.
Yeah, I'll take a first pass. I think, you know, I think when you see kind of these super apps, whether it's in the Asian markets or in the US markets, and I actually feel like it's a bit of a kind of a full circle event, because I think probably maybe 5, 6 years ago, you know, we all saw the great picture of CB Insights, where it kind of had the unbundling of the bank, you know, and you kind of had all of these different arrows pointing to all different dimensions of a bank, and how the fintech industry was, you know, death by 1,000 cuts, and you kind of saw that happening. And now I think what you're starting to see is that come full circle, but it's not the incumbent bank that is kind of reconnecting all these things. You're now seeing fintechs who have become that new hub, and I'll use SoFi as a good example, where it became the hub for, you know, student loan refinancing. But now if you pull up SoFi, they've got savings accounts, checking accounts, a banking charter, investments, loans, you know, credit. Like you can do everything with them. And so while they don't necessarily rise to that full level of a super app in the purest sense, if you kind of look at, you know, some of the ones in the Asian marketplaces like a WeChat or others, where you can do kind of everything in that app, whether it's social or other. When you think about the fintech super apps, those like SoFi, and there's other types of players in the space that are doing the exact same thing. So you have the challenger banks that are doing those very similar things. You even have the traditional players that were in the space, the robo-advisors, who now can offer savings accounts and checking accounts. So you're seeing this convergence because the consumer's demanding that. Consumer doesn't want to have 12 apps on their phone any longer. They want to be able to do all of those things. Venmo, we all use Venmo in a variety of capacities. Maybe not today, but you could invest in Bitcoin and other digital assets today, or at least you get a discount today if you do that. But you're starting to see that convergence of capabilities in apps that maybe a payment app now you can do investing. And so I think it's trying to reduce the friction for the consumer when you have their eyeballs, when you have that mass, communication that you're able to engage with somebody. How else can I leverage that and monetize that traffic in a way that creates frictionless experiences? And you can even see that with Amazon, what they do in the small business in the SMB space. Amazon in the SMB space provides credit and lending and insurance and other other capabilities to the SMB space because they've got the eyeballs, they want to monetize it, they want to make it more efficient.
The one angle that I like to kind of think about is for any of these super or smaller fintech startups that's looking to grow, the key to success is going to be what they do with the data, right? You see increasing number of unstructured and structured data growing, and there seems to be a lot more interest in what you could do with these data sets. For example, when you look at the early days of when Ukraine got invaded, everyone was focusing on energy, right? They're looking at natural gas, they're looking at crude oil, they're looking at Nord Stream 2, what the impact of that was. But very few people realized that there's also a good chunk of sunflower seed oil, canola oil that actually get produced in that region that will be impacted by this, which triggers into the food inflation. India temporarily halting exporting of their wheat. You see Indonesia stop or temporarily halting their export of palm oil, which has become a substitute to some of these cooking oils. And you start to see these ripple effects and different data points bringing different insights. I think we could, as an industry, we could do a lot better in how we observe and sort of leverage those data points for the insight and really, talk about artificial intelligence, but let's take it to the next step of bringing true understanding of how supply chains really work and how this whole really works together.
Yeah, it's a really interesting point. Kind of the interconnected world, how one thing drives another continually. As we talk about some of these interconnected apps and kind of all the different services that our consumers are demanding kind of on demand, what kind of key technologies, and maybe we can talk a little more about the how are some of these players really, how do they get to the innovation level they got to? What's the technology that's driving their ability to create these frictionless experiences and enable, deliver on the consumer demand?
One of the most interesting things that's happening now in between the US and the European markets is that both the regions are thinking about how to share the data in different ways. Right? In Europe, they have open banking initiative and basically have mandated that if you're a bank in Europe, you have to open all your data by APIs to everybody else. And so it's creating this pool of consumer data, which is incredibly valuable, and people can leverage it now in different ways because startups have emerged to basically say, oh, I can take that data. In the US, we have these aggregators like Plaid and Yodlee and others, now Stripe, that are basically taking the private market approach to the same kind of problem. But no matter how it gets solved, this ability for a consumer to have all my data brought together in a place that suddenly software can make sense of in a way that I've never been able to do before, except maybe with a human financial planner, is very, very powerful. And it actually means that the benefits of financial planning can be spread much more broadly than they have been able to spread so far. So that's one aspect of this I'm very excited about.
Yeah, I would agree. Personal story real quick for 2 seconds. I recently refinanced my mortgage before the rates went through the roof. Thank you, good for me. So in doing so, I learned that my current banks and a lot of other banks, they're completely desegregated in terms of like where you go for your loan and where you go for your assets. Entirely separate, and it creates friction for me because I can't log into one place and see everything across the board. So do we anticipate, at some point this omni-channel customer experience, being created through a fintech or through this space, with some of these super apps, etc.?
Well, I think that's why, yes, and I think that's why you're seeing the rise of kind of the challenger bank, digital bank experiences, because they're not beholden to kind of that, legacy, the loan department doesn't talk to the retail banking, and doesn't talk to the wealth management groups.
Right.
And so that's where I think that creates the frictionless experience because you're not beholden to, the 5 different departments within the organization. But I think to the comment around kind of open banking, we actually just invested in an open banking firm based in the UK called Bud, and one of the things that they do quite well is leverage that data to the comment around the data, leveraging AI, natural language processing, machine learning to really provide that knowledge and insight to the consumer, but also to the financial advisor. And as we go to the next panel around financial wellness, that's really the key, because when you think about that kind of holistic view around what a consumer expects and wants, but also if you're in that financial advisory side, you want to be able to have that total view. And so I think, when you think about your own personal experience, I mean, one of the things that we're seeing with some of the fintechs is that ability to kind of break down those silos, and they don't have that kind of friction and resistance. And I think a lot of incumbents leverage those relationships to bring in the external to force the breakdown of the silos to deliver greater value to the clients. And I think that's an opportunity for the traditional players, whether you're in insurance, whether you're in investing and banking, is leveraging those external fintechs, and I'm sure you saw that firsthand in your own experiences, to help break down the traditional silos at the enterprise level, to aggregate that data, to pull together and provide those visibilities.
On the technology front, there seems to be two key trends that you see out there. There's one side that's more on the reinforcement learning type of method, where you have a very few human intervention involved into this. And you hear publications about DeepMind and their new latest, greatest, and what they're able to achieve through that. One you don't hear about as much is the ones where human factor becomes a very critical component of the actual machine learning. To give you an example, let's say I'm doing an experiment and I'm looking to do, whether I use a transformer-based NLP or just simpler model, I want to key in on the term recession, right? And I want to look at the overall sentiment or insight through this natural language processing model to see what I can get. Now, when I just use the word recession, everyone in this room thinks about the financial recession, right? However, when you put that into a machine and you use the term recession, to the machine, gum recession is a relevant topic, right? And they'll try to bring that insight into this knowledge graph and thematic outcome, and you will see an output that's very different from what you were anticipating, right? So this is where the human factor comes in. You have to prune out, okay, gum recession is not what I'm looking for, it's more financial focused recession. So some of the things to kind of think about from a two technology.
I love this example because it's sort of one reason why I'm kind of bearish on AI in some ways. Like AI as a magic solution that's going to solve all our problems is actually not a good way to think about it, because for these kind of examples, like computers still have nowhere near the context that humans have to understand massive data sets. They're very good at parsing through lots of numbers. They're not very good at saying not this number, or this presentation, not this presentation. So I think it's better to think about it as the merger of the two, as opposed to AI doing something great. Really using computers, I think it is still very much in effect, and scaling across bigger data sets is possible, but we have not gotten near to the place where you can just turn over a data set or a web page or whatever to a computer and have it figure out what it means.
I just have a quick question about aggregation, right? As a financial planner, I understand being on the side, right, where I have to collect all the data, multi-factor authentication is involved. Do we see that changing, right? Because think about it, all of them break all the time, right?
Yeah.
Like I have to go back, I have to get my client to log back in,
Yeah.
link their account back, and so that's the common complaint in the fintech from our side. Do we see that changing, or is that an obstacle we'll deal with?
I mean, it doesn't work every time. Yeah, I think, and Matt brought it up around kind of this notion of kind of, the open banking component, which is regulatory driven, versus the US market, which is market driven. And I think when it's regulatory driven, the interfaces and the structures get more out of password changes and more to API driven components. And so then you get more stability in those connections. And that's where you don't have the breakage that you would have with a Plaid or Yodlee or some of the other players in the space. That's where I think you're starting to see the transition. And we've even seen it with some of our larger banking clients where they've said, look, we're not going to allow authentication to come in through multi-factor authentication, user IDs and passwords. It must be API driven only. And so then it becomes incumbent upon the institutions that are pulling that data to be technically savvy to be able to do that. You still have the client authorizations and those types of events, but that's where we're seeing the trends happening, is it's moving away from, you know, the screen scraping of the days gone by, but still many of the institutions still foster that. And so, but the API-driven, technology-driven mandates is really where you get less of that breakage and more of that holistic view.
The only other way that that's gonna get solved, because we're, in the US, we're not gonna have a regulatory diktat to say we need to open up all this data, is a company like Apple, for example, basically being the trusted interface, and all the institutions basically saying, if Apple's telling me that this person is who they are, then I'll share my data. Otherwise, we're always gonna have the re-log in, re-off kind of stuff.
Yeah, I was gonna be a contrarian to the AI side, because I think there's huge opportunities, and we're already seeing it today in a lot of different companies that are using AI with large data sets to do predictive analytics. That isn't just it, but I will agree with you completely in terms of the sense that you've got to train the systems appropriately. You've got to train the data appropriately. You've got to have that, you know, human factor that makes sure that that data is not biased data, that data is accurate data, that data is representative of the universe for which you're serving, or else you're just basically training somebody poorly, and you're going to get poor outcomes out of that. But we've seen and we've done back testing within our own, you know, universe around things like, you know, account closures, segmentation based on account closures, growth of assets based on segmentation. And we've gotten into the probably 80 to 90% accuracy levels with those predictive analytics using knowledge graphs and other types of technologies. And so we see startup companies that are doing some phenomenal things in that space. You know, one company, financial planning space, is kind of quite interesting, is they're doing predictive analytics on life events. And so it could be a little creepy, because it's predictive analytics on, you know, guess what, we think you're gonna get divorced, and we think you're gonna have a major medical event based on your demographics, based on census data, based on actuarial data, based on data we ask of you, we can do predictive analytics on that. Now, as a financial planner, that's really insightful, but it's also creepy. And it's you don't wanna be the one delivering that message that, guess what, you're probably gonna have a medical event in the next 4 years. Maybe we should plan for disruption of salary and income. And so, and their accuracy levels, again, are in that 80 to 90% confidence level of the data, because they've got massive data sets that represent what that looks like. And so there's opportunities now. How do you use that data to create value, which I think gets into some of our other topics around how do you engineer trust? How do you build confidence? And one of the companies we just spoke to yesterday, they're in a certain space where they're getting access to data, but they lead with trust and security and data protection. But they're gonna sit on a gold mine of data. And as a company that we're potentially investing in, we're like, how do you monetize that data? Oh my God, that's great data. That's interesting. And they're like, yeah, that's super interesting, but we're leading with trust. We're leading with building confidence in our consumers. And if we don't do that, we won't get the data, we won't be able to build our business. But how do you recalibrate that? And I think that's when we think about data and usage of data for AI, machine learning, building a business, gaining better insight for both the consumer experience and the enterprise. How do you, I call it a data privacy paradox. How do you still build the trust and engineer trust, but also how do you provide value back to the consumer as well as back to the individual enterprise who may be trying to service them?
Yeah, that's a great point. It's kind of the chicken and the egg example. You know, do we get the trust to get the data, or do we get the data and break the trust? And it's
No, I mean, if there's one lesson we can take from the last 20 years of the computer, is that people will totally give away their data for entertainment, social connections, or whatever. Like, they're happy to do it.
just to not have to use a password.
Just to not have to use a password. It's like kind of amazing. I wouldn't have predicted it, but it's true that people actually don't care all that much about their data. But that's a mistake. Like that, and we see it with how, you know, our data has been monetized against us in some ways.
Yeah, and I have a client that is working similar to what you were talking about in terms of how they're leveraging some of the AI and machine learning is unsupervised for clustering and identifying correlations, et cetera. They're essentially building a digital twin of an individual to be able to predict behavior and where they're headed and what they're gonna do, and then marketing towards them. So both from the healthcare side, for what are the outcomes, what are the other aspects of where we need to go and be a healthier environment? How do we, prevent some of that? On the financial side, what are they going to be investing in? What are they going to be looking for? when are they gonna upgrade their life insurance? When are they gonna look for all these other aspects? Kind of predictive to drive those marketing forces. But again, a lot of trust goes into that, and sometimes those models can be biased. So, how do we keep that bias out, and make sure we're breaking some of the biases? We brought up the engineering trust. I think that's kind of one of our final topics, and we do want to take some questions in just a couple minutes. But with all this data we're getting, like, how do we kind of inspire confidence with our customers? How do we make sure that we are keeping their data secure, but then also we're showing them an accurate representation of what it should be?
I mean, I simplify it to giving users control, and allowing them to control their experiences. And I think, you brought up Apple, and I think that's a great example where I think what Apple really does well is creates transparency, but also provides control, where you can opt in or opt out. But it's kind of that transparency and control, those two things combined creates that confidence. And that's, to me, how you engineer trust through a user experience. And then I think providing value back. So if I do provide you this data, then what do I get in return? Not just you, but what do I get in return as the consumer? And I think that gets back to the point of kind of like, everybody is happy to provide data, to an Amazon or to somebody in that experience, because you're getting reciprocal value. You're getting value back with people like, you bought this, suggestions, you may look at this product, or if we're watching Netflix or whatever it may be, we're getting reciprocal value, so we're comfortable with that. But if I don't have transparency on how that data is being used, then it creates, then your trust meter starts to go down. I mean, I think how many of us, have watched a video on YouTube or on TikTok or something like that, and then the next thing we know, we're in Google search and an ad word comes up based on what we just watched. So that's where you kind of then start to get into your head like, oh, that's creepy, and now my trust level's going down because there's not transparency or my ability to opt out of how my data is being used. So I think it's kind of that, control and transparency is kind of, front and center relative to that.
So I'm gonna take a slightly different technology approach from this. So without creating panic, right? Anything that's encrypted could be decrypted, right? If you look at the growth of quantum computing, and if the qubits really execute on what they promise they will, everything we know about security changes, right? But probably for me, and I'm not a naysayer to any of those guys, but probably the bigger immediate factor is the human factor, right? Once again, there are certain things we do that's probably not the safest. So before the quantum computing grows into this, what it's supposed to be, human behaviors and some of the things we do probably is a bigger security hazard that kind of breaks that engineering trust from a data perspective. And look, part of me says we're okay, right? Because whenever I look at YouTube, their recommendations for, I'm like, why are they recommending this? I don't understand this. I don't see the correlation between my past search, my past YouTube research side, or anything on that. I just don't understand how the algorithm works, right? It's supposed to be one of the better ones, and yet the results tell me that they're still far off. But the other hand, there are some emerging technologies and things you hear and you see. I think DARPA just released a blockchain concern article just like 5 minutes ago or 10 minutes ago before we started this. So, I hope we do the right thing, right? I hope there are a lot more good people out there trying to do the right thing, and hopefully we become a little more aware of what we do within these free platforms and how we interact with them. And I think if more people are aware of what the true impact of that is, we'll be in a relatively better spot.
But I think there are two types of companies in this space. One is the regulators are gonna tell us what we can and can't do, and we're gonna abide by the regulations. And then there's the companies that say the regulations is the floor, but actually what we need to do is do the right thing. And so, I mean, one of the reasons I was so happy to join American Express is because I think American Express, and I also think Vanguard, by the way, are the companies that say the regulators are the floor, but we're gonna think about the best thing for the customer in the long term. And by taking the customer approach of saying, how would I want my data treated, or how would I want myself marketed to, then you build an asset, the trust asset, that will last in the long term as people get more and more used to it, right? And people get more and more aware of the fact that their data is being manipulated.
And I'll end up this good. I think also trust has two dimensions to it. When you look at something like Coinbase as a good example, if anybody's from Coinbase, sorry. But I think, right now there's a lack of trust with Coinbase because there's been rumors floating around that if they go bankrupt, I lose my crypto because they're the ones who are holders of the assets. And so I think there's different levels of trust as well. Is there trust in the entity, and especially in this climate, in this market? If I'm using FinTech as a company, I'm using, fill in the blank, whether it's Coinbase or somebody else. If there's a bad recession, are they still gonna be around? What's gonna happen to my data? What's gonna happen to my money? What's gonna happen to, who are they? And so I think even this notion of brand, where brand didn't matter when things are good, and it's the cool FinTech startup, does brand now matter when things are tough? Because we have a certain sense of confidence. I'm putting confidence in quotes because, great financial crisis, confidence even at that point in time, we had to bail out some of the largest financial institutions in the world. But does confidence now make brand matter more? And I think that's also a nuance of building trust, because it's, if I am backed by, so some of the challenger banks, some of the FinTechs have large financial institutions that are FDIC insured that are behind the curtain. And that can engineer trust. And in tough times, I think those FinTechs can lean into that to build trust. But if you're somebody like SoFi who bought a charter and now it's part of who you are, now if you're banking with SoFi, do you still have trust? Are they gonna lose their stadium rights? Those types of things, do they have the capital to do something like that? So I think trust kind of has both data, trust what you're doing with my data, but also just trust in the institution as well.
Yeah, that's a great point. We're going to open up for questions. We have about 5 minutes here in the back.
Yeah.
Stand up, so. I'll try to be heard. So, what Ross was talking about a second ago just struck a chord. So I'm currently the interim CFO of a fairly large crypto company, not Coinbase. And I have a banking background, long financial services background. And the collision of the Silicon Valley and the finance and regulatory thing is thrilling and shocking at the same time. So in some conversations over the past few months, I'm like a speed bump. Well, what do the regulators say? What do we think about suitability of that product? And it's like, suitability, what's that? And I explain, and they say, oh, and then, well, they're off on product development. So my question is, from your guys' perspective, how do we continue to manage that from a privacy perspective, from a product development perspective, from a compliance perspective? I mean, it's like watching things happen at the speed of light. It's really exciting for me, but it's still scary at the same time. It's a roller coaster kind of thing. So that clash and collision of development and regulatory compliance and accounting compliance and all the rest.
Yeah, great question on just the regulatory compliance of the space. I mean, I think one of the things that, just even from an SEI standpoint, and especially, certainly digital assets, I won't say crypto because I think digital assets has a pretty broad spectrum. It is a collision of two worlds. And I think when we think about it, it's not necessarily the asset itself, but how do you think about the traditional components in the financial services world around how do you handle those assets? Everything from how do you custody those assets? How do you do regulatory, KYC and AML on those assets? How do you report on them on a statement? How do you do tax reporting? How do you do, rebalancing? How do you just think about those assets in terms of the traditional value chain and the plumbing that's necessary to support that? And so when you say custody of a digital asset, what does that mean in today's world? And how does that relate to existing custody definitions that exist in the world today? And so you have cold storage, you have hot storage, you have who's got the keys, you've got all of these different components. And so I think the levers are different, but I think to your comment and to your own experiences, the fundamental elements are the same. Yes. How do we report on it? Are we compliant with it? How do we custody it? How do we report on taxes on it? all of those different elements. And so that's how we're looking at it from an SEI perspective. Regardless of whether you believe in Bitcoin or Ethereum or NFTs or whatever the digital asset is, consumers know that that's a future thing. However that materializes, there will be some great consolidations that'll happen within the market given the conditions, notwithstanding the SEC's ruling this morning on a big cryptocurrency ETF. They did not rule in favor of that, and so I think there'll be continued kind of consolidation and elements on the asset side. But I think as financial service institutions, we still need to be beholden to the regulatory compliance infrastructure elements that consumers expect of us to engineer that trust. Trust in both kind of the institutions, but also trust in terms of what we do every day.
I have lots to say, but I want to make sure other people have a chance to ask questions because it's a very interesting topic.
Okay.
Yeah, so now we're innovating in days instead of months and years. And I'm getting frightened by what you're all saying about digital twins and life events and the fact, and ML and NLP, you still need to train them, but they can give you very strange results. So I'm thinking back, for railroads and steel and others, humans and crowds got out of hand, and they had to be dealt with by regulators in the 30s eventually. I think in that case they just broke them up. And now there's talk about that sort of thing, like Meta getting too big or something. So where is the frightening part going to break the branch, and what's going to happen with all this technology? Because we're talking to people about solving problems. Are you going to need NLP? But it's going to take a couple months to train it. But we can give you the app in a couple of days. It's like change in a flash. Where are we headed with this? Do we know what's going to happen? How is it going to be? How are we
We don't know what's
going
going to happen. But I mean, and this is your question ties in with that question also, because I feel like there's an amazing opportunity actually for a new brand, whether it's SoFi or Binance or Coinbase or Chime or whatever, to say we are working with the regulators. In fact, we are compliant with regulators. In fact, it's going to be easier for you if you keep your money with us, then we are going to be compliant as Vanguard or American Express is. I think that's a brand differentiating opportunity that larger companies in that space should take advantage of, because once you get through the compliance yourself and stand up your compliance groups, et cetera, you have a barrier to entry against the other upstarts that are trying to come up and take your customers from you. But I haven't yet seen it. There's a Mario Andretti quote, which entrepreneurs love, which is, if you're going too fast, if you're not a little out of control, you're not going fast enough. If you're not a little out of control, you're not going fast enough. And crypto in general has been going way too fast, way out of control. So they need to slow it down a little bit so that society can catch up to it, and that would be probably better for the asset class overall.
We might be in the roaring 20s again.
Well, yeah, I mean, I think even when you think about car manufacturers or railroads of the days, I mean, there were 300 plus car manufacturers when the cars first came out, and then consolidation happened. And in the cryptocurrency world, you've got 13,000 different cryptocurrencies that exist in the market. It's not just Bitcoin and Ethereum and the top 5 that everybody hears about. There's 13,000 of them. There is a consolidation that's going to happen. It will happen. And all of the different FinTech startups, that consolidation will undoubtedly happen. So I think change and innovation begets, and the lack of barrier to entry with cloud computing and AWS, and allows any 4 of us in this room to get together, create a digital asset cryptocurrency company, and we could be up live in 90 days. Because there's zero friction to allowing a barrier to entry. Are we regulated? Do we care about being regulated? We'll get eyeballs, we can be up and running. But then what's gonna happen is either somebody's gonna acquire us because we did something unique and innovative, or we did something bad and we get squashed by a regulator or something of that nature. But to me, innovation is this natural kind of explosion and then consolidation and retraction. you know, and I think speed of change is just the nature of the beast in today's world. We all get iOS updates if we have iPhones, you know, every other month with this dot release. I have a Tesla, I get updates on my car every other, you know, month, you know, that type of thing. That's just the nature of the beast. Now, whether or not that creates, you know, cataclysmic event, or that just is now continuous improvement, continuous refinement, because, and even if something's not working, I know next week it'll work. And it's not like I don't get too amped up about it, you know, that type of thing. Yeah.
From an institutional investor venture point of view, you got three great strategics up here. It seems like we go through waves and phases of partnering with strategics. So where are we now, and what's really best practices? You know, whether it's a Series A, you know, do we co-invest, or are you guys gonna sit on the fence because you really wanna control, and you're gonna wait till, you know, some event outstanding? But it's always been a bit of a challenge to partner, as I say, you know, I know you don't wanna do pre-revenue, but as you get to the 1 million and 10 million ARR, you know, do you wanna be in the same security, or you just wanna get to know the company and then, you know,
Well, I think
acquire it?
that's a great question. I mean, I don't know, I'm a fan of the All In podcast. I don't know if other people listen to it, but the All In podcast is a combination of kind of, you know, pure venture investors and strategic investors and others. And I think there is that natural ebb and flow of kind of what happens in the market. I think depending upon what the thesis is of a strategic investor, it varies. So we lead with kind of that strategic mindset. How is it going to impact SEI and the clients for which we serve? And then we look at it from a financial. I think it gets down to our lens as a traditional VC versus strategic. Is our goal, do we have alignment of goals with that particular startup? And that's a really important conversation to have, because if you're looking for the 100x return, I'm not looking for the 100x return, and I don't want you to steer that company to that 100x return. I want you to steer that.
Settle at 10.
You know, and so I think it's really making sure that there's an alignment of goals when we invest, more so than it is Series A, B, pre-revenue. I mean, we focus on Series A and B with exceptions at seed and C or Series C. So we're looking for somebody who's got that kind of, you know, product market fit, you know, kind of in that right space. But we're really looking for, how is this going to help a financial advisor? How is this going to help a bank? How is it help an investment manager? How does it help SEI scale? And so we're looking at it through that lens. Certainly we look at the financials, and it's kind of a 1A, 1B, but we're leading with the 1A, which is strategic impact type of thing. But as long as our goals are aligned, let's sit down and have a conversation, kind of language. And I think that's contrary to somebody like a Google Ventures, you know, where Google Ventures is, we're return focused.
Yeah.
You know, and there's many CVCs that are purely just return focused. And you know, last week, you know, Xerox launched their CVC, you know, only a few months ago. They're return focused vote first, then strategic second. And so it really does, making sure that there's goal alignment there.
Awesome. I think we can take one more question. We're kind of at time, or a little bit over, but go ahead.
I'm just wondering if anybody on the panel sees a little bit of disconnect, you know, particularly to go into a recession. I go back to something that Matt started with, is, you know, if your company isn't, you know, garnering new customers for, you know, you're probably not a great spot. You know, with some of the references to, you know, predictive financial planning and, you know, making better aggregation so that you can create, you know, better outcomes for your clients, harvesting AI. Consumers don't care about that. You know, I think Kitsa says that, you know, usage of money guide is about 5%. You know, consumers don't care when you do a financial plan, what it means, or whether it's better than the other one that they had. And I wonder, the tangible ROI, particularly going into a recession, on some of these companies that you're talking about. You know, how are they going to make the case that it's going to build my business quicker and make me more money?
Can I piggyback off that?
Yeah.
Because it was similar to mine,
Yeah.
from the advising perspective. Like, because I agree, unless technology is great, you can't do anything without me, right? So, like, is there an aspect of accountability that you guys are looking into? Like, holding the client accountable, right? If I had that incorporated in software, right, that's something that is the hardest thing in the world. Like, do you see technology taking over some facet of those things?
Yeah. So first off, I mean, I think that Kinsis quote is a is a problem for current financial advisors and Money Guide Pro, but not for financial planning and what software could actually be, right? Money Guide Pro, no offense, is not a good piece of software. It's not helpful for the end consumer, and it's hard for the financial advisor to use. But other things are coming that will make it easier to gather all this data together and project out futures and let people play with it. So just because the current state of software is bad, it does not mean that it won't be better. In fact, if you look at any software, it gets better and easier to use. And so the answer to your question then is absolutely. Like, I think this software, you could think about it like you think about your Fitbit, you know, which is like, I know my goals, I know where I want to get, I know how many steps I have to take today. Help me get there. Encourage me when I get there. Help me budget better, but also help me make more. Help me think about my longer term goals in a more tangible way so that I can take the steps I need to in order to live the life I want to live. Like, everybody wants that. It's just the software hasn't delivered it yet.
I'll get back to your ROI question because I think that's spot on, because I think, to me, is how does this technology create business value? It's not technology for technology's sake. So when you think about something like AI or an NLP, it's how do I create personalization or next best action for the advisor, or personalization for the consumer to be smarter about their finances, or help the advisor be smarter. So I think things like next best action is a great example where that technology, next best action, is an AI-driven based technology, but it should help the advisor identify what clients I should be contacting based on market conditions, based on their current portfolios, based on their goals, to help me better service my client, so that way I can either get more wallet share from them or stop them from leaving me because performance sucks. So I think that, to me, is when we think about technology, to me it's always about cool tech, but what's the business value? And we run into fintechs all the time, not Matt's company, but we run into fintechs all the time in the space where it's like really cool tech, but the advisor looks at it and goes, how's it gonna help me grow my assets under management? How's it gonna help me better service my clients? How's it gonna help me grow my business? And I think you take that and you exponentially grow that. It's how do I make sure that the technology solves a problem and it's not a hammer looking for a nail.
Yeah, and those companies are gonna have a lot of developers available to hire soon.
Yeah, well, there's literally a website called layoffs.fyi that I love. And literally, it's fun to look at and scary to look at because it's all of the Silicon Valley companies and a lot of brand name companies. It literally has the number of layoffs, when the layoffs happen, and some of them even have a Google Sheets of the names of the people that you can contact. And what I said, it's really kind of going from left to right from the US marketplace. Silicon Valley, back to your comment of that collision, you're seeing a lot of layoffs happening, and you're seeing a wave of those things happening coming across the US, and I think that's kind of the scary part. And then when you think about kind of how is all this going to impact our clients that we serve every day, that's how do we get in front of that? You know?
Yeah, really the business doesn't change, it's just leveraging the technology as the enabler to drive what we need to. But I know we're right at time. Thank you all. Appreciate the conversation. Thank you to the esteemed panel here.